and welcome to this interview series where we bring you face to face with the experts who manage your money. Watch on to learn about their strategies, insights, and the stories behind their investment decisions. Joining me and my colleague Chirag today is Ashish Nayak, Equity Manager at Axis AMC. Welcome, Ashish.
Thank you very much, Ruchira.
Now, to begin with, you started your career as a software engineer at Hexaware Technologies. What motivated you to, make this shift to equity markets?
Wow. A lot of my formative years, if I have to go back, were into science, technology, and obviously there was a liking for mathematics and quantitative side. So obviously the choice for me when it came to graduation at that point of time was engineering. Got through into computer science as a course, and hence joined a job in software engineering. As I started working in the industry and I saw how, let's say, a corporate is managed, what I realized is while technology is driving the business, the one who is actually driving everything from a project level to the company are the management, and that's where, be it the team lead, be it the project managers, be it the BU head, or for that matter the CEO, listening to them, understanding how their strategy is driving the business, kind of inspired me to look at that area of education, and hence my further goal was to get into management and hence try to learn how businesses are managed, and maybe probably also do that at some point of time. Over time, what I realized is when I was preparing for my management entrance exams, maybe going through various news reports, listening to macroeconomic trends, and also while I was working in the corporate industry, where some of my clients were multinationals in the US, and I got an opportunity to work there, that the finance industry, the management industry there is actually much more evolved, and that actually gave me much more interesting outlook in how these businesses are run. And while I was studying my management, I kind of pivoted away probably from looking not just for the IT side or becoming a project manager, but actually looking at things which were more towards finance. It was kind of a culmination of looking at how strategies are run, some sort of an abstract way of looking at business in terms of vision and strategy and various macroeconomic trends, and then marrying it with the real quantitative side of it, which is the finance of how things are being run. So it kind of was a blend of, I would say, abstract versus getting it into much more quantitative based numbers. And that's where I think finance was something that really interested me as a branch, and hence the pivot into financial analysis. And probably that's what again drove me towards stock analysis and equity markets.
Ashish, for nearly 10 years, you have been a research analyst, first at Goldman Sachs and then at Axis Mutual Fund. What are some of the pivotal lessons which you have learned there over the period of time?
Sure. Absolutely. So again, when I joined post my management studies in Goldman Sachs, it was as a associate in the banking team, which was again very important, because when it comes to banks as a sector, one has to understand the implications of the economy and various sectors in the economy, how they are being affecting the overall health of the banking sector. Now here lies the actual core of while I was doing banking as a sector, the analysis of a bank actually involves a lot of study across various segments. So it was a very holistic kind of experience while it was about for two to 2.5 years that I was on the sell side as a banking analyst. Post that, I joined Axis. I was the only analyst in the team at that point of time when we started Axis Mutual Fund, and there were three fund managers. At that point of time, there were a lot of sectors that needed to be covered. And as we know, from a sell side to a buy side, the transition is actually much more broader when it comes to coverage. Sell side analysts probably look at a fewer set of stocks and they do much deeper analysis into it across a certain sector. But when it comes to buy side, the stocks in the sector itself increase because obviously the requirement of the market is bigger and the team sizes are generally smaller. Over a period of time, I also got the opportunity to cover many more sectors. So I started with cement, agrichemicals, autos, logistics, metals, pharma. So a bunch of sectors kept coming my way, and that was an opportunity to sort of learn them, imbibe those sectors, and then kind of move on to broaden those sector coverages. And when it comes to buy side research, there is also an aspect of kind of what I call as skin in the game, where a recommendation that is given is many a times implemented in the funds. And to that extent, there is obviously a thrill, but obviously to that extent, responsibility of being correct. Now, what I learned here is the fact that, when you are analyzing a business as a sell side analyst or as a buy side analyst, it is not just about numbers. While I was fascinated by numbers and that is what drove me towards finance, what I understood is that the abstract and the qualitative is equally important. To understand a business, one has to really understand the strategy and how that fits in the overall framework of the sector and the macroeconomy. The second part is also important to understand that who is executing these strategies and how are they placed, be it the promoter, the senior management, and what are the competitors doing. So putting all that in framework. So what we learn, or what I learned in my management studies of things like strategic forces, what we call as a Porter's model, or for that matter, various other frameworks that were there for strategy were equally important here, and to understand a business, its potential for how it has evolved over the years and how it can potentially evolve in the future. And then when I started putting that across one sector after the other, there were always learnings that came from the earlier experience that kind of drove also better in the future of how one has to analyze this in newer sectors and newer stocks.
All right, now moving on to the present, how would you describe your personal investment style? Are there any specific types of stocks or situations that catch your eye?
So again, when it comes to, let's say, fund management itself, I think it is more of building on what one learns as an analyst. It kind of becomes the fundamental block, the kind of sectors that I have managed. I think I was lucky enough to look at sectors both from a cyclical perspective as well as sectors which were structural in nature. That kind of gave me a perspective of how to look at various companies. Some companies probably are less cyclical, and hence their business model is to be looked at much more steady state and how that can continuously grow. The other is, cyclical industries where you can see probably companies which kind of come into flavor, do much better in certain periods of time when the economy is doing well and not so well otherwise. So both of those kind of helped me build funds and make portfolios which could have a blend of this. Even when I was managing funds, the initial period, I was doing funds which had a kind of multi-cap strategy where I had to take exposure across large, mid, and small cap companies, and hence the exposure was across the board. The second part was also in terms of the couple of funds that I started managing from the start, which one of them being the Innovation Fund and the other the Business Cycles Fund. Both of these are very different funds in terms of the management style that is required. When it comes to innovation funds, as the name suggests, we are looking for companies that are being driven by innovation across process, technology, product, or business model. And these are changes that happen gradually and over a longer period of time in various industries and by various companies. Or it could be much more disruptive at a shorter period of time from a newer entrant like new age economy. All of this have to be kind of taken into consideration to build this kind of fund. And the other, so that really helped me to understand how these funds can be run. The other was the business cycles fund, which is again very cyclical in nature, trying to understand companies that can, or sectors that can do well from, let's say, 2 to 3 year perspective, and in that kind of build a portfolio based on that outlook, where what is important is a kind of top down approach, where you're trying to find how the economy is doing, how some sectors can do well in this economy environment and on their own for let's say 2 to 3 years perspective, and hence build a portfolio. As the sector kind of mature in their growth, look for other sectors that can do better, so kind of sector rotation. So one can see that both of these styles was something that I was able to manage and understand how to run. As such, my liking has always been, and this is something which I think is core for Axis also, that we like companies which have a decent track record of growth, which is stable as far as possible. And in terms of cash flows and ROC, there is a decent visibility of these parameters. So obviously, one will find a slightly higher tilt of growth and quality in my funds. But when it comes to a style of fund which requires something else, or maybe more cyclical in nature, I have been able to put that in my funds.
All right, Ashish, you mentioned how, for different funds, different management styles are required. Interestingly, you manage nearly 18 funds across diverse themes, like there's blue chip, innovation, hybrid, there are ETFs that you manage. How do you straddle such diverse strategies, if you can explain that?
So as you would appreciate, the passive funds, ETFs that are there in the fund are largely more of following how the index is doing. So really speaking, that is more of following the index, and hence not much of individual capacity that I have to manage on a day-to-day basis. Unless there is a cash flow management. But when it comes to active funds, of course, there is a very different hat that one has to put on for each of these funds. As you would appreciate, most of these funds that we have, which you named, there are co-fund management arrangements. So some of them, there will be a primary fund manager who is actually managing and taking day-to-day decisions. And some of the others, there will be, as we call as a backup, as someone who is kind of helping out on newer ideas if needed, and also being there if at all the primary fund manager for some reason is not available. So to that extent, the team has been built such that we have about 9 fund managers today, and there are various funds where the co-fund management arrangement is existing. So it is decently manageable. There are obviously backstops that have been put up in place so that there is continuity if at all there is, let's say, a requirement.
Now, coming to the specific ETFs, as a fund manager, can you just let us know what's the daily routine of managing passive funds? Because in active funds, you have meeting with the CIOs, various fund managers, buy-sell analysts, sell-side analysts, even the company management. So how is it the day while managing the passive funds?
So as I said, passive fund management, or rather management of some of the ETFs and passive funds, is largely on the basis of cash flow, how they are being, sort of expected, or how they are actually happening in the fund. And to that extent, they are actually routed via the dealer system or dealing system by our dealing team to get the fund in line with that day's cash flows to that day's index. So it's, as I said, more of an operational kind of a thing where fund manager role per se would be much more limited to just ensuring that these things are happening at the back end.
Axis Blue Chip Fund and Axis CLSS funds are struggling in their performance since 2021. What steps are you taking to boost their performance?
So, as you would know, Axis, and as I mentioned, that there is quality and growth tilt that Axis Funds has had in the past, and especially the funds that you mentioned also are having that sort of a higher tilt. When these, and to that extent, the most of the, let's say, investments in these funds for a long period of time was towards consumption-driven sectors, because as we understand there, the growth and quality names were much more prominent. As we have seen over the last, let's say, a few 2 or 3 years, there have been also more growth ideas that have come across various other sectors, and they have also been appreciated and added by the market. We have also made changes in our funds, but to some extent, the changes here were relatively lower. We are doing those changes gradually, and you can see month over month and year over year, a lot of the changes are visible, where not just consumption, but sectors other than consumption, which are investment oriented, or for that matter, even a diversification in the consumption basket itself is visible across our funds, and even the two funds that you mentioned. And slowly and gradually, we are also seeing that this diversification has helped a lot of our other funds, which are relatively easier to change given their size. Here, obviously, the changes have been gradual, and also the benefits are visible slowly.
Okay, now, Ashish, recently the Sensex breached the 80,000 mark. What is your assessment of the market, and what factors do you think are primarily driving the performance?
So, yeah, I mean, Ruchira, as you would appreciate, this is a question which probably was as relevant 6 months back, and I guess the answer would again not be very different from anybody who has been asked this question, even that point of time. See, we know that from the economy perspective, or from when it comes to the domestic economy, things are and have been decently moving in terms of, let's say, the macroeconomics, in terms of the overall situation that we are there, in terms of fiscal, monetary policy, also the fact that there is certain level of continuity that is seen from a policy front that the market has appreciated. There are obviously risks that will always remain when it comes to things like geopolitics and let's say uncertainty that is there because of political changes that are happening across the world, which is where the external sector becomes slightly more vulnerable. Also, the interest rates are one of the highest globally. To that extent, there is a sort of a tilt which can be seen across markets towards the economies and towards sectors and companies that have shown consistent growth. We have seen, as we discussed in the last few years, newer sectors that have been sort of developed in India and have grown much more in terms of newer stocks and newer ideas that have probably come back into flavor, which were not there for almost a decade because of the spends that are happening by the government, because of the newer policies that have been driven, be it into manufacturing, be it into import substitution, export-led, let's say, PLI incentives, etc. Those have driven many more ideas and stocks in the market. So to that extent, we are seeing a new sort of developments across various mid and small cap sectors, and some of them have also been visible into large caps. So overall, this has driven market towards new highs, I would say. And yes, I mean, we know that domestic flows are also a part of this story, which have consistently been behind the some of the parts of the market, while we have not really seen big participation from the FII side, which again kind of becomes sort of a story which can happen if let us say at some point of time there is a move from global investors to look at emerging markets as well as India. So that to that extent, I would say that while one can say that yes, valuations are one of the highest in India, but when you look at the growth parameters, when we look at let's say the ROE of especially the large cap companies in India versus its emerging market peers, there is obviously a decent difference, positive difference that we see in these companies, and to some extent the valuations when we compare versus its emerging market peers, India kind of stands out on both of these fronts. So there is a mix of both. One can't say across the market everything is reasonably priced. There are many stocks which are at much higher valuations, and probably with without, let us say, enough delivery in terms of earnings and growth outlook, there could be disappointments in those parts, in those sectors, and in those stocks. So one has to be careful, one has to be selective of where they are placing their bets in this kind of environment.
You spoke about the various factors which have led to the rally in the Indian equity markets. What are the factors which could derail the rally, or what risk do you foresee impacting the markets going forward?
So, the most important thing now is going to be, because there is not just earnings driven rally, but valuation driven rally. Earnings have to grow in line or with the expectations of various businesses. So that becomes one of the biggest risks from a stock market perspective currently. And wherever there are disappointments, we have seen stocks take a big tumble and probably underperform for maybe not just a quarter, but maybe a year or more. So that kind of becomes one big risk. Other than that, on the domestic side, generally we don't see many risks, but obviously as a market, from when it comes to India, it is always commodities, it is always oil, volatility in oil because of geopolitical concerns that will always remain a risk. We know that oil has remained in the range of $80 to $90 for a decent amount of time now, and that has really helped companies decide on how their raw material pricing and other strategies can work. So that is something, from when it comes to the market, both oil as well as geopolitical risk is something that we have to keep in mind. And that, I think, will be the second biggest risk from the market perspective. Yeah.
All right. Can you please explain how do you balance between the blue chip stocks and the high growth small or mid cap stocks?
Interesting question. So yes, I mean, when it comes to fund management, it is a fine balance that one has to kind of have based on the fund mandate of what they are trying to sort of achieve in the fund. There are fund mandates where there is an expectation to look at high growth companies, cyclical companies, and that will be the focus for those kind of funds. But when it comes to a, let's say, diversified strategy, it will always be that generally one would want to have a stable sort of a base or core of companies, let's say, which are, as you mentioned, blue chip in nature, that can consistently grow, which are as far as possible immune to market volatility. That kind of gives a strong base for the fund to have. And then over and above that, one can always look at alpha ideas. One can always look at some bit of beta because we are in an environment where cyclically things are looking quite strong across various sectors. So that could be another part of the portfolio that is there. So it has to be built sort of not just about a large cap, mid cap, or small cap, but more of, as you mentioned rightly, a stable base, and then building on that with high growth alpha ideas and also some cyclical ideas that can give a higher beta to the fund.
What are the themes or the sectors we are really excited about in the current market scenario, and how are you planning to play those themes in your portfolios?
So one of the biggest theme that we as an economy are going through is the whole change from a services-driven to a manufacturing-driven economy. We also know that while the last decade was largely about consumption, this decade is going to be a mix of consumption and investments. And when it comes to investments, there are a whole host of capex and infrastructure-driven ideas that one has to look at, and themes that one has to look at. Plus the fact that many of these policies also require a very strong base of infrastructure when it comes to things like railways, when it comes to things like port, because a manufacturing plant, as you would appreciate, cannot be built like a services office, because you need, for services, probably the utilities and the requirement of manpower is what is one of the basic requirements. But when it comes to things like manufacturing, you are looking at a whole host of infrastructure setups, be it power, utilities, water, port connectivity, road connectivity, railways, and then finally even the capital goods investments, be it plant and machinery, which are required. And then I am not even going into things like the setup which is required for, let's say, the workforce, which itself can be another sort of a township. So a single manufacturing plant is what this requires. And then there are, let us say, if it is a bigger industry which requires assemblies, for instance, mobile manufacturing, auto manufacturing, you're talking about a whole host of ancillaries, which are also being encouraged by the policies to be made in India. And that actually creates a multifold sort of a growth story. Obviously, these are slightly longer term, which is why probably a lot of these stocks also in this space look very expensive. Some of these can continue to be expensive if they continue to grow in the manner that they are showing right now. If their order book grows, if they keep guiding and achieving higher targets. So I think this is a story that is not for some few years, like a cyclical story, but this is something that can continue for a decade or more. So that is, I think, one of the biggest changes and themes that is there in the markets, which drives a lot of sub themes or sub sectors. The other is also, just looking at India per se. When it comes to consumption, we have seen, just out of COVID, higher end consumption has been something that picked up quite well. We know that there was some sort of a K-shaped recovery in the economy. At some point of time, we should see the lower part of the K also kicking in. We have seen not so great rainfall or monsoons for a couple of years, maybe some improvement there, and also let us say higher spends on rural part of the economy is something that can drive a few more sectors. We have seen announcements on affordable housing in the recent months. So those are the things also one should look at. Third is probably looking at just we have seen a big rally in real estate in terms of how there have been many launches. There are sectors which could probably benefit as second order derivatives out of that in the building material space. So there are many sectors that are looking interesting when it comes from medium term perspective also.
All right. And when it comes to undervalued stocks, what indicators or signals do you rely on to judge whether a stock is undervalued?
So I think what is important when you look at stocks, it is not about just a certain number of valuation, right? I mean, it is not only about a particular ratio versus, let's say, its past or versus its peers, because obviously market is assimilating all the information that is there currently, and over a period of time, it generally finds the right level for various stocks. So what is important here is to understand is what can change in the future for that company, for that business, and for that stock. And that, I think, will matter more when it comes to judging whether a stock is undervalued. What I mean to say is, let us say there is a change in the nature of a business, or because of, let's say, internal changes, because of management changes, or external factors, which is cyclical, economy, etc. Those are the reasons probably where a stock can seem undervalued currently and probably can trade at a better valuation in the future. Obviously, competitive factors also matter in such cases. So I think that is where I would say analyzing a company or a stock holistically in a sector and in the economic environment can give a judgment of whether a stock is undervalued or correctly valued.
Can you share a key lessons you have learned from the past mistakes or the challenges in the equity market?
So obviously, equity market is fraught with risks. One of the basic things that I have understood is assumptions are not absolute. One has to keep reevaluating. One has to keep because obviously, when I say that, how do we do valuation of a company based on various assumptions, based on on the business growth, profitability, etc. But there is also the factor that, as I said, the world is evolving, world is changing. There are disruptive changes happening, and then there are many bigger changes that are happening in the world. Things even such as geopolitics can have affected businesses drastically in the last few years. So assumptions need to be revisited. Nothing is absolute. Keep relooking at that is one thing that I have realized, and obviously be patient, because at times one can probably think that something should go a certain way, and that does not happen. So that's the second thing that I would say, that while we want sort of our assumptions and our thesis to come out correctly, it can sometimes takes a while. The third thing is also to be vigilant of who are the people who are actually running the business. So while we are investors, we are also kind of part owners. But at the end of the day, the business is being run by someone, and how they achieve and how they are able to sort of execute becomes extremely important. At times, a bad execution strategy, or a bad execution with a good strategy also is not a great idea. And businesses are not always the same. They are also evolving. So understanding how the next round of growth can come is also important. So these are the 3-4 things that I would put out as my key learnings, and probably some of them from my mistakes.
All right, now moving on to last question. Every investor has a story about, their first investment. We're interested to know your story there, and what company was it? How long did you hold on to it, and what was the outcome?
So I think I can't name companies here, unfortunately. But as an analyst, one of the earliest sectors that I tracked, I could probably talk about that. There was a business which was not even one of the prominent names in that industry at that point of time. And I was asked to kind of do some research, understand this business. It was a real challenging task to understand how this management can potentially succeed. They were kind of pivoting their strategy from domestic to exports orientation. They had built their relations over a longer period of time, and we know it has been something that I can proudly say has been a great investment for Axis over the years. It has grown, and we have grown with them. There were other bigger peers, in the industry, and I always wondered how this company can beat them and how they can probably be doing something what others have not been able to achieve. But that's really where, as I said, execution comes into play, the right strategy comes into play, patience comes into play, and all of those things is what actually I could actually see in this particular stock happen over a period of time.
Okay, this is the success story, but was this also your first investment?
So this was one of the investments that Axis did as a fund house initially, and as I mentioned, as you rightly said, for a few years initially in Axis, I was part of the investment team as an analyst. So I thought this is the one I should highlight as my first. Yeah.
Sure. Okay. Time now for us to wrap up this chat. Thank you for taking the time for this interaction. It was great having you.
Thank you very much, Ruchira and Chirag.
Thank you. Thank you, Ashish. Thank you.